Hi, you're watching the series A to Z of stock markets and I'm Aarati Krishnan. Today we will discuss circuit breaker. In your class, if your class gets very noisy and two gangs of boys start fighting with each other, what does your professor do? Declare a timeout maybe? That's what the stock exchanges also do. When trading gets very volatile and emotions are running high in the stock market, the stock exchanges declare a timeout, which is called a circuit breaker. A circuit breaker is a specified limit for the index at which the stock exchange halts all trading in all shares. So circuit breakers are usually fixed by the exchanges in advance, and the exchange tells you at which levels of the market the trading will be halted. In the Indian market, we have three levels of market-wide circuit breakers. These are at 10%, 15% and 20%. So, based on the daily close of the index, the 10%, 15% and 20% levels are calculated at the beginning of each day. If the market falls or rises by that amount, immediately the circuit breaker kicks in and all trading across the exchanges is halted. To give an example, let me show you how circuit breakers were calculated on a recent session. The previous day's Nifty closed at 8776. So, the 10% limit is 877.6. If the Nifty rises by 877.6 or falls by this amount, immediately the circuit breaker for the day will kick in and all trading will be halted. Similarly, there are limits at 15 and 20% also. Both Sensex and Nifty declare circuit breakers every day, and when the circuit breaker in one of the exchanges is hit, the other also will stop trading. Basically, trading will resume after a specific halt. Traders are given say half an hour to 1 hour to recover from it and then resume trading. All the orders which were already in the system before the circuit breaker will get invalidated, and once the trading resumes again, you will have to punch in your orders again. Actually, stock market is a place where emotions run very high. Greed and fear, panic, all these have a lot of influence on how stock trading is done. Sometimes when the markets begin to fall rapidly, everybody wants to jump in and put in sell orders. So the market crashes very fast. Similarly, if a market is rising very quickly, everybody may want to jump onto the bandwagon and buy stocks. But investors get spooked when the markets move too much within a day. So this is why stock exchanges have a circuit breaker mechanism, so that traders will have time to pause, think over the development before reacting in haste. There is also a concept called circuit filter, which is applied to individual stocks. So when a single stock moves by 5%, 10%, 15% in a single day, trading in it can be halted. One of the much talked about trading halts in India occurred when the UPA won a landslide victory in the Lok Sabha elections in May 2009. Reacting to the win, the Sensex opened 10% higher and the Nifty 14% higher on May 18, 2009. That triggered a trading halt. But circuit breakers are not always triggered by runaway emotions of traders. Error can sometimes trigger them too. NSE's circuit breaker was triggered on October 5, 2012 when a broker from MK Global Services punched in erroneous orders into the system and caused the Nifty to fall by 920 points shortly after the market opened. An interesting aside, Indian markets have had a circuit filter mechanism for stocks for many years now, but this was not so in the US. It was only after the flash crash episode in 2010 that the US regulators decided to have a circuit filter mechanism in place for individual stocks.